Welcome to the C9 Podcast Show, and a huge welcome to all the C9 followers of our podcast and business page joining us today. I am your host, Lex.
And I am your expert guide for today, Vera. We are thrilled to have you with us for this deep dive.
Absolutely. Now, right off the bat, I want to speak directly to you. If you are an Australian business owner or a C-level executive, operating in the financial services sector right now, this specific conversation is absolutely critical for your operations. We're looking at a fundamental shift in how business is done.
We really are.
Yeah, and the core topic of this deep dive is how custom agentic AI applications are actively replacing manual back-office work in Australian banking. And we're talking about right now in 2026.
That is the reality on the ground today. It's not future tech anymore.
Exactly. And we are basing today's analysis on an incredibly comprehensive 2026 industry report, alongside a detailed executive analysis that outlines the exact state of AI in Australian financial services today. And our mission for this deep dive is, it's very simple. We want to give you the knowledge, the context, and the clear next steps to move your business from simply being informed about AI to being completely ready to actually deploy these systems.
And I think that transition from informed to ready is really the defining challenge for leadership teams today. I mean, think about it. Every single morning across financial businesses in Brisbane, Sydney, Melbourne, and every regional center in between, highly skilled professionals are arriving at work.
Having their coffee.
Getting a coffee, sitting down at their desks, and spending their first few hours doing the exact same manual tasks they did yesterday. We're talking about reconciling transactions line by line, re-entering data between disconnected software systems.
Just copying and pasting, essentially.
Yeah. Right, and running identical compliance checks without any variation.
Yeah.
The work itself was designed for a world that simply no longer exists.
Okay, let's unpack this. Because the sheer scale of the hidden costs in financial back offices is, well, it's staggering. I was looking at the McKinsey 2025 Global Banking Report from our sources, and I honestly had to read the number twice.
It's a big number.
It found that between 50 and 60% of all full-time equivalent roles in banking operations are currently tied to work that is repetitive and rule-based. 50 to 60%.
Yeah.
That is not just some minor inefficiency sitting on the edges of your business. That is sitting right at the center of your operations. It's in your compliance team, your settlement desk, your onboarding workflows, and your month-end reporting cycles.
It is a massive anchor on growth, and the cost of that inefficiency actually compounds across four very distinct dimensions. So first, you have the direct labor cost. You have your most expensive resource, your highly skilled, highly paid financial professionals, spending their working hours on tasks that require absolutely no original judgment.
Which is incredibly frustrating for them, too.
Exactly. And then second, there's the error cost. Manual data handling introduces errors at statistically predictable rates. Humans get tired. In our heavily regulated environment, those errors mean compliance breaches, expensive remediation, and really painful audit findings.
Which nobody wants to deal with.
No, definitely not. Third is the delay cost, which we'll get into in a second because it's vital. And finally, the opportunity cost. Every hour your finance professionals spend on routine processing is an hour they are not spending on client relationships, risk judgment, and the kind of strategic analysis that actually grows the business.
Let's circle back to that delay cost, though, because that feels particularly crucial right now. We operate in a totally different landscape than we did even, 5 years ago?
It's an absolute structural constraint today. Let's look at the NPP, Australia's new payments platform.
Right.
For anyone needing a quick refresher, the NPP is the national infrastructure that settles transactions in real time across the country. The money moves instantly. But if your back office reporting and reconciliation cycles are still measured in days or weeks because they rely on manual human processing, you have a massive disconnect. You are essentially operating at human speed in a real-time environment.
Yeah, that's a huge bottleneck.
Exactly. The core problem isn't that you have too many people. The problem is that your highly capable people are spending too much time on work that simply shouldn't require a human being anymore.
Which brings us to the technology that is stepping in to replace that manual effort. Now, for anyone listening who might be feeling a bit of AI fatigue, because let's face it, the buzzwords are everywhere right now, can we get a plain English explanation of what Agentic AI actually is? Because reading through the sources, it's vastly different from the RPA, or robotic process automation, that executives were being pitched a decade ago.
It is categorically different. Think of RPA like a train on a track. It was essentially a fixed step-by-step script. It was incredibly rigid.
Right. If anything changed, it just stopped.
Exactly. If an exception occurred or if data format changed slightly, the RPA train derailed. It broke, it stopped, and it immediately escalated the issue to a human to fix. It had no self-directed planning and very low true business autonomy.
It was just following a literal checklist.
Precisely. Agentic AI, on the other hand, is like an off-road vehicle that you simply give GPS coordinates to. It operates with goal-directed autonomy. It reasons, it plans, it adapts to new data on the fly, and it figures out how to pursue an outcome autonomously.
That's a great way to picture it.
The difference is like giving a junior employee a rigid checklist where they can't deviate, versus giving an expert the authority to actually look at a problem, adapt to the variables, and solve it.
Let's ground this with a concrete, real-world example from the source material to make it tangible for the listener. Think about a classic headache end-of-day settlement reconciliation. An agentic AI system does not follow a rigid script. Instead, you just give it the goal. It autonomously ingests the day's transaction data from your various systems. It applies the appropriate matching logic for each specific transaction type.
Right.
It identifies discrepancies that exceed the thresholds you've defined. Then, it classifies each exception by type and likely cause, drafts an exception report in your standard internal format, and automatically routes it to the correct team member. It does all of this without being instructed step by step. The goal is the instruction. The execution is entirely autonomous.
And that shift from task automation to outcome automation is what makes this a fundamental structural redesign of how work gets done. It's not just an incremental process improvement. According to the Wolters Kluwer 2026 report in our stack, we are seeing institutions achieve processing speed increases of between 30 and 50% across their core operational workflows because of this shift.
Here's where it gets really interesting, because if you're an executive sitting in your car or at your desk wondering if this is still just conceptual future tech, the evidence shows it is absolutely not. This is happening in live production environments right now. Australia's big four banks, ANZ, Commonwealth Bank, Westpac, and Macquarie, have already deployed this exact technology at scale throughout 2025 and 2026.
The case studies from these major institutions are incredibly revealing. Take ANZ, for example. They became the first bank in the Asia-Pacific region to deploy Salesforce Agentforce across their entire business banking division. They used agentic AI to consolidate 20 previously disconnected data platforms into a single AI-powered interface.
20 systems down to one. That's huge.
Exactly. And the measurable outcome of that, their business bankers recovered the equivalent of 1 full working month per year that was previously lost to just navigating fragmented systems and copying data.
1 full working month per banker per year returned to the business. That is a massive injection of capacity.
It really is.
And then you look at the Commonwealth Bank of Australia, CBA. They deployed AI-powered real-time voice and text agents. These agents proactively engage suspected scammers, intercepting fraud at the exact point of attack. On top of that operational defense, they're using a generative AI layer to personalize the mobile banking interface at a highly individual level. The AI actually bases its layout and recommendations on each customer's unique transaction behavior.
Then you have Westpac, which took a different but equally impactful operational route. They deployed AI agents inside their engineering function to handle highly complex code migration tasks. A process that previously required 6 full days of specialist developer time now takes 1 hour.
Wait, I have to pause there.
Yeah.
A 97% reduction in time for a 6-day engineering task is just staggering. But my immediate thought as an executive is, what happens to quality control? If an AI is moving that fast, how is that governed?
That is the beauty of how these specific systems are engineered. The AI does the heavy lifting of the migration, mapping the code and identifying dependencies, but it still operates within strict architectural guardrails. The human engineer shifts from being a manual typist to an editor and reviewer. The quality actually goes up because human fatigue is removed from the data entry side of the equation.
Okay. That makes a lot of sense. It elevates the human role rather than just replacing it blindly. And wrapping up the big four examples, Macquarie Bank deployed an AI-powered assistant designed for instant, personalized client responses across their digital channels. It handles routine inquiries and materially slashes the operational load on their frontline teams, meaning their human staff can focus on high-value, complex client conversations.
What's fascinating here is the strategic reality this creates for everyone else in the market. If you look at McKinsey's analysis, they identify something called pilot purgatory as the defining risk for Australian mid-tier institutions, credit unions, and fintechs in 2026.
Pilot purgatory. That paints quite a picture.
It really does. Pilot purgatory is what happens when organizations trial AI in narrow, isolated use cases, maybe a little chatbot here, a little document reader there, without ever connecting them to the core operational workflows that actually drive the business. The MIT and EY Banking AI survey found that 70% of banks globally are using or piloting agentic AI.
70%.
But, and this is the critical part, Neuron's Lab and Deloitte research from 2025 shows that 84% of financial organizations now realize that success requires partnering with specialist implementation developers. You cannot just buy software independently off the internet and expect it to transform your complex business.
So what does this all mean? How does a C-level exec listening to us right now actually apply this? Where do they start so they avoid falling into this pilot purgatory and permanently lagging behind the big four?
You start by targeting your highest value back office processes. You don't try to boil the ocean. Not every process is equally suited to be your first deployment. The prime targets always share three characteristics. They are high frequency, they follow predictable logic with manageable exceptions, and they carry a material cost or compliance risk when done manually by humans.
Makes sense.
The 2026 data highlights 5 specific processes to automate first.
Let's walk through those organically because there are a lot of acronyms here that we should probably translate for the listener. What's target number 1?
The first major target is trade settlement and reconciliation. Because of those NPP same-day settlement obligations we talked about earlier, manual reconciliations simply cannot absorb the volume pressure anymore. PwC data from 2025 shows that applying AI agents here results in up to 90% time saved.
Wow. Okay, target 2 is heavily regulatory. It is AUSTRAC compliance reporting. Let's pause and define that for a second. We're talking about the Australian Transaction Reports and Analysis Centre, which enforces the AML, anti-money laundering, and CTF counterterrorism financing legislation.
Right.
These laws require real-time transaction monitoring and highly structured reporting. According to KPMG, firms using AI agents to deliver this at scale, complete with full audit trails, recorded an average 35% operational cost reduction.
Which is massive overhead relief. And that flows right into the third target, customer onboarding and KYC verification. KYC stands for Know Your Customer. The corporate regulator, ASIC, has incredibly rigorous KYC rules to prevent fraud.
Very strict.
Agentic AI gives you the speed of a slick digital onboarding experience, but with the deep investigative rigor of a manual compliance review. KPMG notes this makes the process 50% faster and 30 to 40% cheaper.
That actually bleeds right into the credit side of the house for our fourth target, which is loan assessment and credit processing. I was looking at the notes on this, specifically around the new buy now, pay later regulations that rolled out in 2025 and 2026. They are forcing lenders across Australia to essentially rebuild their credit infrastructure. AI agents are taking these complex credit decisions from days down to literal seconds.
And the fifth and final prime target is financial reporting and board packs. For ASX-listed firms and APRA-regulated entities, those disclosure deadlines are non-negotiable. Agentic AI is taking the painful monthly close preparation time from days down to hours, while simultaneously reducing the risk of human error in the spreadsheets.
And the financial returns backing up these 5 targets are incredibly compelling. According to an Accenture and IDC study commissioned by Microsoft in 2025, the average return is $3.50 for every $1 invested in agentic AI.
Right.
But the top 5% of deployments are seeing a massive $8 return for every $1 invested.
If we connect this to the bigger picture, that huge gap between an average $3.50 return and a top-tier $8 return is entirely determined by implementation quality. It is not determined by the AI model itself.
Interesting.
Those massive $8 returns come exclusively from purpose-built, bespoke applications that are engineered specifically to an institution's unique data, their specific workflows, and their strict compliance obligations. Generic software subscriptions simply do not generate those top-tier operational savings.
That perfectly brings us to the Australian context, which is so unique. A lot of business owners might be wondering, why can't I just buy a generic, off-the-shelf AI SaaS software as a service subscription, plug it in, and get these results?
It comes down to structural reality. The global market for AI software is dominated by products built for North American and European financial institutions. They are trained on transaction patterns, risk models, and regulatory frameworks that simply do not map to the Australian environment. For example, they do not natively integrate with Australia's specific settlement systems like BPA, OSCO, or the NPP.
And the regulatory roadblocks are even more severe. Generic tools are not built around AUSTRAC's highly specific reporting formats. They aren't designed for APRA's CPS 230 standard.
No, they aren't.
For those not deep in the compliance weeds, CPS 230 is the strict operational resilience standard that demands you prove you can manage risk and keep critical operations running. Generic tools also fail to meet ASIC's specific guidance on explainability when it comes to AI-assisted lending decisions. If you try to adapt a generic, off-the-shelf tool to the Australian regulatory context, it requires the same amount of development investment as building a custom application from scratch, but you don't get any of the control.
Precisely. The sources detail 5 structural advantages of custom building your AI applications in Australia. First is proprietary advantage. A bespoke AI application is an asset your business actually owns and builds equity in. A SaaS subscription is just a commodity your competitor can rent tomorrow.
Exactly.
Second is data sovereignty. The Australian Privacy Act, 1988, along with the proposed 2026 reforms and APRA's data governance expectations, often prevent you from processing core operational data offshore. Custom applications can be built and hosted locally on Australian servers to maintain total compliance.
The third advantage is dealing with legacy systems. We know that regional banks, credit unions, and mid-tier lenders often run core banking systems that are 15 to 20 years old. Custom connectors can bridge the gap between modern AI and those old legacy platforms. No generic AI product does that natively.
That's a huge pain point for a lot of execs.
It really is. Fourth is unique regulations. Your specific APRA license conditions, your unique anti-money laundering program, and your internal credit policies can be architected directly into a custom build, making it highly auditable.
And the fifth advantage is total cost of ownership, or TCO. SaaS licensing scales up aggressively. You pay for every new user and every increase in transaction volume. But a bespoke application is built once and then maintained on a continuous improvement cycle. That means you avoid escalating per-user fees as your business grows.
In fact, independent research in the sources confirms that enterprise spending on off-the-shelf AI actually fell from 38% to 32% of budgets recently. Companies recognize that bespoke development is mathematically cheaper over the long term, which is exactly why 84% of financial services organizations conclude that success depends on specialist implementation partners.
It's the only way to safely integrate this technology.
And that leads us to how these systems are actually built in the real world. Let's talk about the specific process used by C9. C9 builds these systems for Australian businesses, with expert application developers operating locally across Brisbane, Sydney, and Melbourne. They aren't just advising on strategy, they actually design, build, integrate, and deploy the applications. The typical timeline for a well-scoped, single-process agentic AI application is about 10 to 12 weeks.
C9 utilizes a rigorous 6-phase process to ensure the AI serves the business perfectly. Phase 1 is discovery and workflow mapping. They document your target process with extreme precision, mapping the inputs, the decision logic, the compliance checkpoints, and the human escalation triggers. This prevents the expensive revisions that ruin poorly scoped projects.
Right, getting it right from day one.
Exactly. Phase 2 is architecture design. They design the decision model, the data flows, and the governance controls. You review and sign off on this before a single line of code is written.
Then comes Phase 3, which I find really interesting. Build and shadow testing. The AI application is developed and then run in shadow mode right alongside your existing manual process. Imagine a digital worker sitting invisibly next to your human worker. The AI processes the same data, but it doesn't execute anything live. Instead, C9 compares the AI outputs against your human outputs to calibrate accuracy and refine the logic before the AI takes over any actual workflows.
That shadow testing is critical for trust. It proves the system works. Then Phase 4 is parallel deployment. The AI runs alongside the manual process for a validation period to build operational confidence and catch any final gaps. Phase 5 is production go live. This is full deployment, complete with human oversight dashboards, alert thresholds, audit trails, and documented escalation workflows. All the necessary APRA-compliant documentation is produced as a standard deliverable right here.
Which is a huge relief for compliance officers.
Absolutely. Finally, Phase 6 is continuous improvement, involving monthly performance reviews and model retraining.
But with all this autonomous execution, we need to address the elephant in the room. What about the risk?
This raises an important question regarding governance. The most common reason Australian executives delay AI investment isn't the cost, it is governance uncertainty. How do you deploy autonomous AI in an APRA-regulated, ASIC-supervised environment safely? Look at the terrifying data from Infosys in 2025. They found that 95% of organizations using AI agents had experienced at least one AI-related incident.
95%. That's almost everyone.
It is. 77% of those incidents resulted in measurable financial loss. And the kicker, only 2% of organizations had adequate governance guardrails in place.
That is exactly why C9 builds governance into the architecture from day one. It is never treated as an afterthought or a feature to bolt on later. The system includes human oversight dashboards, ASIC-compliant explainability for lending decisions, and AUSTRAC-compliant audit trails that provide time-stamped records of every single decision, every data input, and every logic path the AI took. They also architect frameworks for human review to comply with the proposed 2026 Privacy Act reforms.
APRA's CPS 230 requires regulated entities to demonstrate material control over operational processes. If you cannot produce audit trails and escalation workflows, you are simply not compliant. By embedding this into the architecture during Phase 2, C9 ensures the AI is fundamentally auditable by your regulators from the moment it goes live.
So, to bring it all together for you, the listener, the cost of waiting is no longer zero. Agentic AI isn't arriving in the future. It is already operating at scale in the institutions competing for your customers right now. The businesses moving decisively in 2026 are building capabilities that compound over time. Faster speeds, lower error rates, vastly reduced costs. The gap is widening, and competitors are moving. The correct starting point isn't some massive, chaotic transformation program. It's automating your single highest-value back-office workflow with a bespoke, properly governed AI application.
The time to act is now, before the structural cost of manual inefficiency becomes a permanent disadvantage for your business.
Exactly. And that is why we are issuing a very clear call to action today. C9 is Australia's leading custom software, apps, integration, and database developer company. If you want a prioritized roadmap for your first high-value AI automation, I strongly encourage you to book a free discovery session with their expert team. You can do that right now by visiting www.c9.com.au. Also, please make sure to hit that follow button and share this podcast with anyone in your network, your C-suite, or your operations team who could truly benefit from this critical knowledge.
As we wrap up this deep dive, I want to leave you with a final thought to mull over. If Agentic AI successfully handles all the procedural and rule-based work in your back office, how will you fundamentally redefine the value of a financial professional in your business? When technical processing speed is no longer a human metric, how will you hire, train, and measure the human skills like ethical judgment and complex relationship building that truly set your institution apart?